Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other industry leaders to help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am very happy to introduce our audience to Eric Gerster, Chief Investment Strategist with AlphaCore Wealth Advisory. Eric, welcome to the podcast.
Rob, thanks so much for having me. Pleasure to be here.
Thank you. I appreciate that. And welcome to Newport, Rhode Island, your first time in Newport.
It is my first time in Newport, despite living very close to here for many, many years and going to school in Boston. And it is beautiful, and it's a beautiful day here.
It really is. Well, thank you for being here. We're part of a conference today. We're hearing from a lot of very interesting investors. I'm very interested to hear from you as an investor as well. So thanks for taking this time. Before we get started, I'm going to read your biography for our audience. Eric is an accomplished investment professional with nearly 3 decades of experience in the financial industry and demonstrated success throughout fluctuating market cycles. Eric's broad industry background and thorough understanding of long and short institutional investing have effectively served individual and institutional clients. His risk management philosophy and his knowledge of credit, equity, and alternative investments enable him to design and implement a wide range of asset allocation strategies for clients with varying financial goals. Prior to joining AlphaCore, Eric led Magnolia Lane Financial Advisors as the company's CEO and founder, offering clients customized investment portfolios that focused on meeting their long-term goals and achieving financial security. Eric's career includes working as a vice president and global credit officer at JP Morgan and as an equity analyst and portfolio manager for Rowe Price. He also spent a decade managing long and short equity hedge funds for the global hedge fund firms Point72, Guggenheim, and Millennium Management. Eric volunteers as the chair of the investment committee for the King's School Endowment and is a member of the Jesuit Investment Committee that oversees the Jesuit Foundation Trust. He holds a bachelor's degree in finance and operations and strategic management from Boston College and an MBA from the Wharton School at the University of Pennsylvania in Philadelphia. In his free time, Eric enjoys playing golf, gardening, traveling, and spending time with his wife, 2 daughters, and 2 dogs. Eric, thank you for being here today. Congratulations on all your success. We're very happy to be hearing from you on this episode.
Well, thanks, Rob. It's really a pleasure to be sitting here with you. And as I listen to that bio and I think about the 3 decades of my investing career, I think the one thread that is really common amongst that whole time is just the love and passion that I have for the investment markets. You know, I've always been someone who's very curious, and being able to take that curiosity to my career every day has really been a blessing.
That's wonderful. Thank you for sharing that. We can't wait to dig into that. Before we do, I heard a rumor that you were a lifeguard back in Minnesota. Is that true?
Yes, it is true. I spent 8 years lifeguarding, coaching swimming, teaching young people how to swim, and did some lifeguard training for a while I was in college and taught new lifeguards. And so, yeah, I understand we have that in common.
We do. Tell me, I'm going to tell you what my thread is to lifeguarding. But what were some of those skills that you picked up in those years, lifeguarding, teaching swimming, that you've carried forward in your career?
Sure. Well, I think one of them is, you learn a lot about assessing risks as a lifeguard. You're watching, whether it be a pool or in Minnesota, a lake or a beachfront, and you're assessing various swimmers and the risk that you have to help them at some point, that they may get in trouble. And that certainly applies to the investment world, where any investment that we look at, we're trying to assess what's the risk that we're taking here. The difference, of course, is that you're trying to balance that with the reward in investing. And obviously in lifeguarding, that's a little bit different. I think the other thing that has really helped me is I always loved working, particularly with young kids, teaching them how to swim and seeing the joy in their face as they learned how to swim. And that's something that as an investment professional, I've always loved working with young analysts and analysts early in their career and helping them develop, mentoring them. And I'm very happy to say that many of them have gone on to their own successful careers where, I often joke with them that the student becomes the teacher, and I sometimes call them now for advice and for help. So that's something that I think really transcended.
That's great. Thank you for sharing that. The reason I ask is I'm a professor, as you know, at Drexel University, and I've been doing a research study on ocean lifeguarding as it relates to entrepreneurial mindsets in young people, particularly 16 and 17-year-olds who are going on the beach or at a pool, and they have that responsibility of maybe a life and death situation, or just trying to train or teach someone a new skill. So all of that is very helpful. So thank you for some more anecdotes from my research.
Yeah, no, that's great.
So can you share a bit about your career journey? So when you think about that thread and how you ultimately came to AlphaCore.
Sure. It's been a very interesting, 3+ decades. But really it began as a young person. When I was 11 years old, my father was a physician, and he was a physician who was bound, determined not to be the doctor who didn't know anything about how to take care of his money. And so he wanted to learn about investing, and he started getting these value line research books that, of course, now are online, but they used to come in these large stacks every week. And he would study investments, and he got me very interested in it. And I bought my first shares of IBM when I was, I believe, 11 years old. And I know today IBM is not thought of as a dynamic growth company, but in the 1980s, it certainly was. And that really ignited my passion for the markets. I always loved numbers and statistics. Used to study the box scores in the newspaper as a young boy. And so when I got out of college, I had always wanted to work on Wall Street. I went to JP Morgan, did a training program, and then began a career in credit there, which was really an incredible background, because one of the things that I think a lot of equity investors lack is really a true understanding of how to really break down a cash flow statement and a balance sheet. And that shocked me later on when I became an equity investor, that many did. But I found that was a great training ground. But JP Morgan said to me, "Great, you're great in credit. We love you in credit." I said, "Well, I want to be an equity investor." And they said, "Too bad." So that's what led me to go to graduate school, get my MBA at Wharton. And then I went on to work at Rowe Price, which was really an unbelievable place to be trained as an investor, particularly in something that served me so well later as a hedge fund investor. And that's how to think about not just the return that you're going to get from an investment, but how much risk do you have to take to get that return. And that's something that at this conference today, we've heard from certainly some of the credit people, is how much risk do I have to take for every unit of return I'm going to earn? And that's not something that every equity investor thinks about. They're oftentimes thinking about, how do I maximize return, without thinking about that downside. And so I worked at Rowe Price for 6 years, and it was a great training ground. And I saw the internet bubble in the 90s, and then I saw that burst. And so I went from, golden child, because I was covering software at a time when everybody wanted to own software, to I was a lemming, because suddenly every software company had gone down 80 or 90%. So I learned very early on how humbling the investment business can be, and that whenever you feel like you're on top of the world and you're so smart, you're about to be smacked in the face. And so I've tried to keep that as I've gone through my career. So I transitioned from there to the long-short equity world, and I went to work for Steve Cohen's firm, Point 72 in Stamford, Connecticut, and really had another great training ground. I went from a place where we invested very long-term and we made decisions based on those long-term, to a place that was certainly more trading-oriented and more short-term oriented. But what the takeaway was is that the great investor still was thinking about, how much risk do I have to take to make a certain amount of return. And so even though they traded differently at the two different places, both thought about risk and return. And so that was something that carried me through. It served me well, helped me tremendously in 2008 survive and thrive in what was, one of the most challenging investment years, certainly in the last 50, 60 years. And, after a decade of working in the hedge fund business for a couple of different places, I looked around at my children and my wife, and my kids were growing up fast. And I thought, boy, I don't spend a lot of time with my kids. I don't really see them. I need to make a shift in my life here so that I can have a little bit better balance. I still want to be an investor. I love investing. And so I left the hedge fund business and ended up starting, really by accident, my own investment advisory, with the benefit of several of my former executives that I invested in their companies coming to me and saying, hey, we love how you invested. Would you think about helping us with our investments? And so I formed my own investment advisory firm. And I had that firm for a number of years and grew that to a nice size and a good amount of clients, but really didn't want to build out the infrastructure and everything to take it to the next level. But I had a desire to build another business. I had built a hedge fund and I loved doing that. And that was when I was introduced to Dick Pfister, the CEO and founder of AlphaCore. We hit it off right away. He looked at my background and said, boy, I'd love to have you come on as our chief investment person and really help us take our business to the next level. And so about 2 years ago now, we put our businesses together, and I think it's been really fantastic. I'm so happy I did it, and I love the team that we have at AlphaCore.
Congratulations for that. That's great to hear. I'm looking forward to hearing more about AlphaCore, but you did say something that resonated. I think it's interesting that you have a background in credit with equity long short, because both of those disciplines require a healthy balance of optimism and pessimism. How do you strike that balance?
Well, I'm a very cynical person, and that's good as an investor. It's not always good in the rest of your life, as I've learned. It can sometimes make personal relationships more difficult, but it definitely helps you as an investor. So I think one of the things that really helped me in a perverse way is early in my career at Rowe Price, I made several quite large mistakes, really, in terms of dollars that fortunately, in the scale of the size of Rowe Price, were survivable, but later on in my career, likely would have been fired for those mistakes. And learning from that and realizing that the humility that you have to have in this business, that your successes are oftentimes not for the reasons that you think you're going to be successful, and paying attention to what could drive failure, how could I be wrong, and thinking about that every day. I woke up every day worried about what headline could come out today that I'm not anticipating. I mean, every day I had a to-do list of these are the things I'm going to work on today. And I almost never got to the top ones because I got to work and 2 or 3 things went right to the top of the list. And so that ability to recognize that things can go wrong, you can't predict. And also you have to learn from your mistakes, right? You're going to be wrong so much as an investor. And one of the things is about investors. Most people who are successful in the investment business have been really successful in other areas of their life, but haven't failed at many things in the rest of their life. Great investors can often be wrong in the equity business almost 50% of the time. So you have to get the big ones right. And when you get them wrong, you'd have to make sure you're not as big. That's a really hard thing for most people to overcome. And so learning from your mistakes is something that you really have to be able to do.
I'm hearing a lot of baseball parallels, that's for sure. Thank you for sharing that. So for our audience who may be less familiar with AlphaCore, you came into the firm a few years ago. Could you describe the firm for us? What are the services that you're offering? How do you think about putting together a client portfolio? Are you managing assets in-house? Is there open architecture, external managers that are part of that program? We would love the overview.
Sure. So at AlphaCore, we're a full-service wealth advisory firm. We offer financial planning. We think that's certainly one of the most important things that we can do up front. And we offer full investment services for clients. But I think what really differentiates us, and if I think back to our founder, Dick Pfister, and why he created the firm in the first place is, so really the concept is that for a true investment portfolio to succeed over time, we believe it needs 3 elements. So you need to have traditional stocks or equities, traditional bonds or fixed income, and you need to bring in alternative assets. Okay, so there's really 3 legs to the stool. And really the way to think about it is stocks and bonds traditionally are beta, right? It's very hard to really differentiate or beat the market, if you will. All the research shows that, as we know. And yet there's this whole class of managers out there in alternative assets, whether it's private equity, venture capital, private credit, private real estate, hedge funds, that have proven that they can generate alpha. And so what we think about as around the core of your investments is stocks and bonds, and at the core is your alpha. So that's AlphaCore, right? And so the way we differentiate ourselves is through finding those alternative strategies. So we're creating our own in-house allocations to these different strategies. We're doing our own research on managers externally, which I think is another big differentiator for us. We have an in-house research team that I lead. There are 5 of us on that team, tremendous experience and backgrounds, whether it's our director of research who worked for one of the largest allocators on behalf of pensions and endowments in the country, or one of our senior analysts who was on the multi-asset team at Morningstar. We just have tremendous experience and breadth of knowledge that allows us to do the research on these managers and help us identify differentiated solutions.
Makes sense. Thank you for sharing all that. So based on the way you've described AlphaCore, as you think about current market trends that are currently being identified by the firm, how do you balance then the internal with the external? Again, kind of the optimistic and the pessimistic.
Yeah, sure.
Where does it come together?
Sure. Well, I think one of the things I'd say is that, as I said, we want to start with wealth planning when we think about clients. And we have, over 1,400 households that we work with throughout the US and internationally. And each of those households is slightly different from one another. And so we really think about customized portfolios that are led by the investment team and then ultimately developed by the advisory team. And so each investor is going to have a little bit different profile. As an example, we might have an investor, and we have a lot of these, who they're later in their lives and they want to generate a lot of income. And so we have a host of income solutions that we've developed for people, and we can put those together and we can have them in a more liquid format that might have more daily liquidity solutions that might be more traditional fixed income, or we can move to an interval fund structure, a quarterly liquidity structure, or maybe a drawdown structure, someone who's comfortable tying up their money for 10, 12, or 15 years in some cases. And so really it's going to differ. And that's, again, where I think that research really comes in. How do we identify the right trends at the right time? And I'll give you an example. So a few years ago, when rates were effectively zero, AlphaCore would have had almost no allocation to traditional fixed income. Because why would you have an allocation to something where if rates go up, as they did in 2022 a lot, you'd lose 10, 12, 15%. So equity-like losses, right, in what was supposed to be safe. So we had allocations to alternative assets that were outside of that. Now, today, we are using more traditional fixed income again in some of our allocations. And so that's going to differ over time depending on what the market environment's like.
You have a background in hedge funds. Your CEO had said that alternatives is the third leg of the stool. So what do you think is driving this increasing interest in alternatives among clients, particularly within wealth management? Another way to ask it is there has been a democratization of alternatives in client portfolios, particularly among RIA clients. So what do you believe the role of alternatives should be in a client portfolio, understanding that it's bespoke and every client has its own needs? But when you think about it holistically, how do you think about alternatives in a portfolio?
Yeah, I would say alternatives are critical to pretty much every client's portfolio. There are 86% of the companies that do over $250 million in revenue are private, according to Cap IQ. So if you only invest in public assets, you're ignoring a huge chunk of the economy. And, I believe, and certainly we believe as a firm, that's not a good idea. There's a lot of ways to invest in these assets. As you mentioned, the democratization of alternatives, that was something that, our founder, Dick Pfister, was with a firm called Altegris many, many years ago. And they sort of started this trend of democratization, and it's really blown up. And you see all the asset managers now trying to figure out, how do we create a product for the high net worth space? And some of those products are really valuable and great ways for people to access asset classes that in the past only institutions could access. And today, now all investors can access these. Some of them are not so great, right? And they're asset classes that probably don't need to be created for the high net worth investor. And again, I think that's where we come in as research people. It's our job to identify what are the best asset classes and when should they be used. But again, I think every investor should have some component of that alternatives, or you're just leaving out too much of the investment universe.
Thank you for sharing that. Can you elaborate on the external manager research process at the firm? How are you sourcing managers? What are the types of characteristics that you look for when or before you underwrite one of those managers?
Sure. So we undergo a thorough due diligence process on any manager that we're going to onboard. And that process, similar to if you're doing stock research, right? It starts with who are the people. So I often found as an investment professional that oftentimes you were betting as much on the management team as you were on, the ultimate product or service that the company offered. You could have a great management team and a lousy product or service, and they might make that a good stock. You could have a really outstanding, product or service and a bad management team, and it would be a bad stock. And so it starts with the people who are actually making those investment decisions that we spend a lot of time getting to know and understanding how do they invest, how are they different. I ask them a lot of questions thinking about my background and what I think made me successful, particularly in the hedge fund space. But really, it applies across disciplines. And we're trying to make sure that they're doing something different. I mean, that's one of the things we're hearing here at the Havner Summit, which is how are these smaller investors differentiating themselves to help themselves grow? And we've heard some great stories here today that I'm really intrigued by and want to do some follow-up on.
The people side of it is arguably the hardest part to ascertain. Some of them are trained by very good marketers, and they can tell a great story, a great narrative, but you have to dig a little bit deeper. How do you get deeper into the understanding of what makes a good portfolio manager? What makes a good asset management partner for AlphaCore?
So you're 100% right, first of all, that there are many people who have raised billions of dollars of assets because they're good at marketing. And when you actually break down their track record, they're not adding any real value. So one of the things we look at is what is their track record? How have they accomplished that track record? Have they truly added alpha or differentiated performance versus whatever asset class they're in, be it credit, real estate, equities, you name it. And I'll give you an example. So if we were to look at a long-short equity manager and they run 50% net long, right? We're going to look at that performance and say, okay, well, if I took half the return of the S&P, is it the same or better as what they did, right? So was it really just the beta in their portfolio that delivered the return, or did they truly add alpha, right, with taking this risk? And so it's really important to discern, are they adding true value? Because you're paying a lot of fees, right? That's one of the questions we get asked all the time by clients is, but we're paying all these extra fees. Why should we invest in these things? And I'll tell you, in the hedge fund business, for example, many of these hedge funds are levered long only, right? That's what they do. They charge 2 and 20 and they run levered long only. And if you really break it down, they're not adding a lot of value versus just buying the S&P 500.
Interesting. Speaking of hedge funds, which hedge fund strategies are you finding most effective today in delivering that alpha for your clients, particularly given current market conditions?
That's an easy one for me because I come from a world where multi-strategy investing, so investing across different strategies, be it credit, equities, quant, and then taking out the market risk through a series of hedging so that you're truly adding alpha if you're generating positive performance. I've always found, and the track records of the firms that we invest with has proven that that's where you add real alpha and justify the fees that you're paying. I'd say in the long short world, we're not finding as many differentiated managers. I think 2022 proved that there were a lot of wolves in sheep's clothing, if you will.
I do. Looking across asset classes, are there any specific areas of opportunity that you're spending a little bit more time on today?
Yeah, I think one of the areas that we think is really interesting right now is in alternative credit. And so that's obviously a very broad category. One place that we like is real estate credit. So one of the things that happened with the failures of Silicon Valley Bank and Signature Bank in early 2023 is it forced many commercial lenders, particularly the regional banks, to pull back. So those regional banks are the largest lenders in the United States to commercial real estate. When they pull back, it opens up a massive opportunity for private lenders to come in and take advantage of that opportunity set. And the second thing that's happening is you had many real estate loans made on a floating rate basis back at the height of real estate, or even on a fixed rate basis, that are now coming up for refinancing. And that's forcing dislocation in the market. And even in an environment where the overall economy is quite strong, there's been a lot of dislocation, and we think that's creating opportunity. And the thing that I like about it too is when we talk to clients or even other investors about it, they say, "Oh, I wouldn't want to do that. Real estate's terrible right now." And Warren Buffett's famous quote, of course, is be greedy when others are fearful. And so I think that's how you find differentiated opportunities.
We just heard a very interesting conversation about energy transition. So when you think about energy as an asset class, particularly renewables versus traditional, how do you strike that balance with your client portfolios, or maybe just yourself as an investor, when you think about opportunities that are coming up, arising, every new year as renewables are maturing?
Yeah, I think that really gets to something that I thought about a lot during my investing career overall, which is investing around themes and trying to find large themes. So obviously AI and tech is one. But as we heard today, certainly the energy transition is another one. And I think that's an area where, frankly, we've struggled to find a real differentiated manager at this point in time. I think it's a huge opportunity set, right? It's going to happen. It's going to happen slower than, as we heard today, slower than most maybe would like or think, but it will happen. There will be massive winners and massive losers, and that creates opportunity as an investor. But I'm still looking for that really great way to capitalize on that.
How are you as an investor taking in all this information, particularly top down? Macroeconomics, it's, as one of my high yield managers used to say, it's like drinking water out of a fire hose. There's no shortage of it. Half of it's wrong, half of it's right. And in the middle, who knows what you're really getting?
Right.
How do you take in all this information? And what do you find is the most effective in distilling the idea to something that's actionable?
Well, as they say, a broken clock is right twice a day. And so one has to be careful with forecasts and predictions. I think one of the things that really helped me throughout my career is I was able to take all this information and read it and analyze it. And you have to be able to pick out, well, that's great, but what are the things that are going to move markets? What are the things that are going to move stocks or bonds or whatever particular investment you're looking at? And so, I start my day every day by looking at 4 or 5 different, broad sources of information and macro pieces and just trying to take in a lot of information and distilling, well, what out of this is actually going to matter, right? And if you can figure out what's going to matter, and obviously I don't get it right all the time. As I said before, I get many, many things wrong as an investor, and one has to be willing to pivot. That helps shape a broad view from an asset allocation perspective. So we start there. And then after that, we start doing our due diligence. Oh, okay. We like artificial intelligence. Well, that's great. Now what do you do with it? Okay. A lot of people own NVIDIA. What's another way to play it? So we've gone, for example, to find stealth AI plays, if you will. So I think we had some investments in some of the utilities before I think everybody suddenly discovered that's an AI play. And again, you can get a lot of those things wrong, but it helps to take that information, distill it. And then I think the other thing is, I learned as a hedge fund investor, you have to be willing to pivot, right? You have to be willing to say, the information's changed. I have to re-underwrite if I like the idea or not every day. It doesn't mean I change my portfolio every day, but I want to re-underwrite my ideas almost on a daily basis.
As a hedge fund investor and an allocator, they haven't gone away. I don't want to say they're back, but fund of funds has become more prominent, particularly among wealth managers and outsourced CIOs who are offering fund of funds solutions on behalf of their clients or for their clients as another alternative or another option for that business. What are your views on fund of funds?
I'm generally skeptical of fund to funds I mentioned fees before, and something that we get asked about a lot. And look, the bottom line is you can hire outside managers to help manage your clients' assets, and they're going to charge fees and we're going to charge fees. You have to deliver a net return to your investors that meets their goals, or you won't be in business, right? Your clients are trusting you with their assets. That's a sacred trust, really. And you have to deliver for them. And so fund to funds, generally speaking, don't deliver on the fees that they charge. Now, there are some newer solutions coming out, especially in the democratization of alts, where we're seeing some fund to funds that are not charging the egregious fees and putting together a very nice slate of managers. But I'd say it's few and far between.
How about early stage managers, emerging managers? So that manager with less than a 3-year track record, less than, we could say $2 billion, but let's say less than $200 million. You're coming from the alternatives world. So that's a little bit more realistic or in line relative to long only. What are the views on emerging managers? How aggressive or often will you be having those conversations?
Yeah, that's a great question. So it depends on the asset class. So I would say within venture capital, we're about to launch I think, very exciting new venture in the venture capital space where we're going to do exactly that. We're going to bring together a host of emerging managers that have very successful track records at larger managers. And then if they've done a really great job, they tend to start raising a lot more money and the returns start to compress. And so I think with strategic venture capital, that's something that we're going to look for where we think we can really differentiate and bring a great solution on a fund-to-fund side to our most sophisticated investors.
Well, I'll absolutely be recruiting you for the classroom then. It's something that we're very interested in at Drexel University. So thank you for sharing that.
Sure.
Well, in your white paper, Win More by Losing Less, you emphasize the importance of managing downside risk to compound returns more consistently over time. It reminded me of my first job at Greenwich Associates. I was working for Charlie Ellis, winning the loser's game, where he argues that the key to long-term success is investing in avoiding mistakes rather than chasing outperformance. So how does that philosophy translate into AlphaCore's business and approach to manager selection and investments?
It's really core to how we invest on a daily basis and core to our belief why alternatives are so critical. Most people that invest, because it's human nature, they tend to buy high and sell low. When the market's at an all-time high, as it is right now, they tend to get excited and want to buy the market. And when we're in periods of stress, like 2022 or early in COVID or 2008, they tend to want to sell. And so they miss out on great market returns over time because of that stress. And so if we can put together a portfolio that will protect your assets better in the downside, you will stay invested longer. And yes, you will sacrifice some in booming markets because we'll have those more protective investments in there. But by staying invested over the long term, your long-term returns will be better. And so that's really the philosophy behind it.
Interesting. We're talking, and for the right reasons, a lot about long-term investments. But demographically, we're going through a major generational wealth transfer process that's going on, particularly with firms like yourself. So how are you balancing that succession planning, that generational transfer of wealth as it relates to some of these longer term assets?
Well, that's an interesting question because I definitely have that conversation with clients from time to time, particularly older clients, where I will say to them, look, we've run this wealth plan for you. We've showed you the evidence that unless you dramatically change your lifestyle, you can't possibly spend all this money. You're going to pass a lot of it on, in many cases, to your children. And they may think about their investing horizon much differently than yours. As an example, I talked to a client who's 76 and says, well, I'm in the 9th inning of my life. And I said, okay, but if you pass on millions of dollars to your children and they have 30, 40, 50 years of their life left, should we think about investing differently with your assets? Should we take a piece of it and invest it in private equity or venture capital? Whereas that 76-year-old might say, I just want income investments that give me income now.
Coming back to the near term, as you think about some of the opportunities that are coming across your desk, so over the next 12 to 18 months, where do you anticipate spending your time?
Well, I think, one never knows day to day, obviously. As I said before, it's a constant reevaluation process. But, I think we're looking for where can we add real alpha, right? That's AlphaCore, right? We're trying to find differentiated opportunities. And so we constantly have sort of a bullpen list, if you will, of these are things that could potentially be interesting that maybe we're doing something in today, but we could be bigger in. So as an example, I mentioned venture capital. I think that's an area where we're going to put a lot of focus and a lot of energy launching this strategic venture capital product. And one area that's particularly interesting in that is biotech and healthcare is an area that has been decimated really in the public markets for a number of years. And yet you're seeing solutions come out that can lengthen our lives or make our quality of life so much better. The market's not rewarded that. Whereas on the artificial intelligence side, you're seeing valuations explode. And so, that'll be an interesting dichotomy for us to think about. I mentioned earlier the real estate lending side and real estate credit and how that's an interesting area. But something that I'm keeping an eye on is real estate equity values have fallen quite a bit as rates have risen, and that may be stabilizing now. We may be seeing some signs of a turn there. So we're looking potentially for an opportunity to get back into, perhaps multifamily real estate or industrial or, data center certainly hasn't seen any value degradation because of AI, but it's an interesting opportunity set over time.
Within venture capital, do you have a preference of generalists versus specialists?
My bias is almost always going to be to specialists because I saw that work so well in the hedge fund space where, I specialized in tech, media, telecom, consumer. And, I think the narrower you can be, the better the chance you have to really know these businesses and know these companies. The more generalized you get, I think the harder it gets to really outperform.
This is probably one of the hardest questions because you've been in the game now for 30 years. The mentors, the people who have influenced you along the way. Is there anyone that you'd like to mention?
Yeah, I think there's two people, and I'm going to forget so many people, so I'll have to apologize for that. But I'd say two people that really stand out for me that helped form me as an investor. One would be Brian Berghuis, who was an early mentor and portfolio manager I worked with at Rowe Price. He runs the mid-cap growth fund there. Mm-hmm. And he taught me so much about investing and thinking about risk reward and sizing. And then I'd have to say Steve Cohen would be the other one, of course, from Point 72. I really enjoyed my time working with Steve, and I learned so much from him as an investor. And he was, I think, very gracious with his time with me. There were times I would say to him, I don't really understand technical investing, Steve. Can you spend some time talking to me about charts? And, he would take the time to do it while running this large firm and all these assets. And it really helped me, I think both helped me become a better investor.
That's great. Thank you for sharing all of that. We can't wish him luck because I'm from Philadelphia as a Phillies fan, but we don't wish him unwell. So thank you for sharing those two examples.
Let's go Mets.
We'll definitely edit that out from our Philadelphia audience, but maybe not. This has been wonderful. Congratulations on all your success. Congratulations on AlphaCore's success. We wish you nothing but more of it. Thank you for being here.
Thanks, Rob. Thanks so much for your time.
I appreciate it too. If you want to learn more about Eric and AlphaCore, please visit their website at www.alphacore.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, please check us out at Dakota.com. And finally, if you like what you're seeing and hearing, please be sure to like, follow, share these episodes. We welcome your feedback as well. Eric, thank you again for a wonderful conversation. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.